It's 1980. You just got your paycheck. Down at the dealership. A brand new car. Or, you could buy shares in a boring soda company. One choice feels smart. The other feels crazy. Buy today. One of them is worth nothing. The other is worth a small fortune. This is the true story of Coca-Cola stock versus a 1980 car. And the math might change how you see every purchase you make. Let's rewind the clock. It's January 1980. Gas lines still snake around city blocks. The economy feels shaky. Inflation is eating paychecks alive. The average American earns about $21,000 a year. You walk into a Chevrolet dealership. The Chevette gleams under fluorescent showroom lights. Sticker price, about $7,200. $7,200. That's roughly a third of your yearly salary just for wheels. The salesman smiles. You'll want air conditioning, he says, tacking on a few hundred more. You sign the papers. You drive off the lot. The new car smell feels like victory. 3 miles down the road, that car is already worth less than you paid. That's not a knock on cars. Cars are tools. They lose value by design. But what if that same $7,200 went somewhere else entirely? Down the street sits a different kind of storefront, a stockbroker's office. In 1980, Coca-Cola is already ancient by corporate standards, founded back in 1886. It sells a simple drink turned global icon, in a red and white can. Its stock trades for just a few dollars a share, split adjusted. Coca-Cola isn't exciting. It's boring. Predictable. Unsexy. Boring is the point. With $7,200, you could buy a meaningful stake in the company. No flashy showroom. No test drive. No new car smell. Just a stock certificate. It doesn't feel like an investment. It feels like nothing is happening. But underneath the boredom, something quiet is starting to compound. Let's fast forward through 4 decades and watch what boring actually did. 1982. Coca-Cola launches Diet Coke. It becomes an instant hit nationwide. Meanwhile, your Chevette needs its first major repair. The bill. Several $100s. 1985. Coca-Cola makes a historic blunder, New Coke. Fans revolt within weeks. The company reverses course in just 79 days, bringing back Coca-Cola Classic. The stock barely flinches. The brand is bigger than one bad decision. 1986. Your car has 60,000 miles. The paint is fading. Resale value, falling fast. 1988. A little-known investor named Warren Buffett starts buying Coca-Cola stock, quietly, aggressively. Berkshire Hathaway eventually holds hundreds of millions of shares. Buffett later calls it one of the best investments of his life. Your car, meanwhile, is now worth a fraction of its sticker price. The 1990s arrive. Coca-Cola expands into over 200 countries. Its logo becomes universal. The stock splits again and again, multiplying your original share count each time. If you'd reinvested every dividend, your share count keeps quietly climbing in the background. 1996. Coca-Cola sponsors the Olympics. Its brand is now among the world's most valuable. Your Chevette, if it even still runs, is worth maybe a few $100s. It's likely been sold, scrapped, or left rusting in a driveway somewhere. The car did exactly what it was built to do. Get you places, then depreciate. The stock did something completely different. It multiplied. By the late 1990s, your original investment has grown many times over. And Coca-Cola hasn't stopped paying its dividend. Not once. 2000. The dot-com bubble bursts. Tech stocks crater across the board. Coca-Cola isn't a hot tech stock. It's not exciting. That's exactly why it survives. Consumer staples like Coke keep selling drinks, recession or not. 2004. The dividend gets raised again, now over 40 consecutive years of increases. This streak earns Coca-Cola a title, Dividend Aristocrat, later Dividend King. Your car, if you kept trading up, has been replaced 2 or 3 times by now. Each new purchase resets the depreciation clock all over again. Meanwhile, every Coca-Cola dividend check, reinvested, quietly buys a few more shares. It's not glamorous. It's just relentless, quiet compounding. Small, boring decisions, repeated for decades, start to look like magic. 2008. The financial crisis hits. Markets crash nearly 40%. Coca-Cola's stock drops too, but people still buy soda in a recession. The dividend isn't cut. The streak continues uninterrupted. By 2010, markets have recovered and Coca-Cola's dividend keeps climbing. 2012. Coca-Cola celebrates well over a century of continuous operation. The stock has split 11 times since the company went public in 1919. One original 1919 share is now, on paper, thousands of shares today. Your 1980 car, meanwhile, is a distant memory, maybe scrap metal, maybe a museum piece. Some collectors do restore old Chevettes. But most 1980 cars are simply gone. There's no dividend check for a car. There's only ever a repair bill. The 2010s. Coca-Cola pushes into bottled water, teas, and healthier drinks. It buys stakes in Monster Energy and other beverage brands. The dividend keeps rising, year after year, like clockwork. 2018. The streak hits 56 consecutive years of dividend increases. Very few companies on earth can say that. Your original $7,200, fully reinvested, has grown enormously. This is the part that surprises people. It's not because Coca-Cola stock exploded overnight. It never does. It's because it never stopped, and dividends kept buying more shares. Time did most of the actual work. 2020. A pandemic shuts down the world. Markets panic everywhere. Coca-Cola's stock dips, but the dividend, again, is not cut. By 2026, that dividend increase streak stretches past 6 decades, a true dividend king. Coca-Cola now operates in more than 200 countries and territories. Roughly 2 billion of its beverage servings are consumed every single day. Meanwhile, the average car from 1980 has been gone for decades. Let's finally put the two side by side. Same starting number. Same year. Completely different destinies. One asset was designed to lose value. The other was built to compound it. Your 1980 Chevette. Purchase price $7,200. Value today, essentially zero. It served its purpose. Transportation, then quietly disappeared into scrap and memory. Coca-Cola stock, same $7,200. Dividends reinvested for over 4 decades. The estimated value today reaches well into 6 figures, possibly further. That's not a typo. That's the power of decades of compounding, left untouched. Exact numbers move with the market daily. Always verify current figures before you quote them. But the direction of the story never changes. Patience beat depreciation, decade after decade. This isn't a knock on buying cars. You still need to get to work. But it's a reminder. Every dollar you spend is a dollar that stops compounding. Sometimes that trade-off is worth it. Sometimes it's just a habit worth questioning. The people who got rich boring didn't pick perfect stocks. They just didn't sell. Ask yourself, what's your Coca-Cola? What boring thing could you be holding right now? This video is for education, not financial advice. Always do your own research. If this changed how you think about money, subscribe for more true financial history. Because sometimes the smartest financial decision looks like nothing is happening at all. Boring held long enough becomes extraordinary. Thanks for watching.